will put on a lot of percent because you'll go parabolic during this period. So I think we definitely, even if we recover and we don't really get the wall of worry type correction we want, we recover, we make higher highs, and it signals that we're in the early part of the bubble phase, then we're still going to get to 10,000, and we're probably still going to get to 200, maybe 250 or more in silver, but we're not going to get to 15,000, and we're probably not going to get to $500 silver.
Garysavage outlines a scenario in which the precious metals market accelerates into a genuine parabolic phase, even if the current pullback never develops into a whole wall of worry correction. In his view, the trajectory already suggests the early stages of a bubble environment where momentum expands faster than fundamentals and price action becomes increasingly vertical. Under that kind of pressure, gold reaching the $10,000 region becomes a realistic outcome, while silver could drive toward $200 to $250 as liquidity floods into hard assets. He emphasizes that these projections reflect a strong bull cycle, not the extreme blow-off targets sometimes promoted at the top of speculative manias. Without the deeper washout that typically fuels a final melt-up, the cycle's ceiling may be lower, meaning the metals still rise dramatically, but not toward $15,000 gold or $500 silver. The path forward is powerful, just not limitless. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I think we're close to breaking it. We've had the initial move up to 50, close to 54, I think it was, and we had a correction of 15%, give or take. And then we made kind of a marginal new high, and now we're pulling back. And I'm trying to, maybe I'll know by the end of the week. Probably just need to see a little more action, but it looks like it's trying to hold that $50 level. If it does, then this turns out to be like a retest of support, and I've got a target of $100 silver in 2026, maybe even as early as late spring of 2026. But I think that the odds are really good that we get there by the end of 2026. So I think we've broken the suppression of the silver market, and I think true price discovery is happening now, and we're on our way. All right, so this is this big-term picture or long-term picture. This was the first phase of the gold bull market, and then the cyclical bear market bottomed at the end of 2015. We started a new bull market, but it started very slowly. It formed as this cup and handle pattern. Here was our last 8-year cycle low in towards the end of 2022. And now you can see that the character of the bull market has completely changed. We have started to go vertical. That's a sign that you're at least in the initial phase of a bubble. And I think we have a lot further to go, simply because this is 11-year base. Might be longer than that. I guess from 2011, 14, 15-year base, something like that. Anyway, the rule is the bigger the base, the higher in space. So I think a base this large, 14, 15 years in the making is going to produce at least a move to 10,000. But you can see the character's changed. The rate of ascent has started to go vertical. So this doesn't suggest to me that we are at the very beginning of a bull market. This suggests to me that we are 25, 26, 27 years into a very mature bull market, and we're well into the second phase of the bull market. Now, let me go to a daily chart, and I'll show you what we really want to have happen, although this is not what retail traders are going to want to hear. But the longer we can stay in the wall of worry phase, the higher this is going to go. And by that, I mean, you need these corrections. This keeps the wall of worry intact. You have, this was a 4-month sideways churn. This was a 2 or 3 month triangle pattern, another sideways churn, another sideways churn. As long as you can continue to have these intermediate corrections, and they can form as either a sideways churn like this has been, or you could get an ABC move. We might be trying to form an ABC move. And by that, I mean, this is the A wave down, it's the B wave bounce, and then you'll get a C wave that'll undercut this low. So you'll get a lot of people that may buy a little early, thinking that this is the bottom, and then they get stopped out when it drops below this pivot here. But really, that's about that's when you really should be adding, not panic selling, because you're pretty close to the bottom once you break this and complete the C wave, and then you start another leg up. And while I think silver's could get to $100 by the end of spring, I think gold is probably has a date with 500 or 5,500 or even maybe more likely 6,000. So you don't need to panic if this turns into a C wave, because it's going to end and then we're going to make a trip up to 5,500 or $6,000. So you're potentially getting a buying opportunity that way. Now, what would change my mind, and this would be the continuing in the wall of worry phase if we come down and make a C wave, and that extends the bull market. If we can keep having normal ABC move corrections, intermediate corrections that last 4 to 6 to 8 weeks, or these long sideways churns, makes the bull market last longer, and will ultimately go a lot higher. If this just turns out to be a half daily cycle low, and we recover, and then we're off to the races again, and we make higher highs here pretty quick, that's what retail traders would like to see. The problem, of course, is that means that we are definitely in the last year of the bull market, and our potential is limited at that point, because we just have a limited amount of time to complete the move. Now, the move will put on a lot of percent, because you'll go parabolic during this period. So I think we definitely, even if we recover and we don't really get the wall of worry type correction we want, we recover, we make higher highs, and it signals that we're in the early part of the bubble phase. Then we're still going to get to 10,000, and we're probably still going to get to 200, maybe 250 or more in silver, but we're not going to get to 15,000, and we're probably not going to get to $500 silver if we lose the wall of worry phase here and we just start to transition into the manic buying phase.
Garysavage explains that silver's breakout toward the mid-50s, followed by a controlled 15% pullback, is behaving more like a structural retest than a failed rally. Holding the $50 level would reinforce that shift, supporting his outlook for $100 silver by late 2026. Potentially even earlier. He views the long consolidation base from 2011 to 2022 as the foundation for a vertical phase now underway, a pattern typical of late-stage bull markets where acceleration becomes unavoidable. Gold, in this framework, remains positioned for a move toward $5,500 to $6,000 once the current corrective wave completes, whether through a full ABC flush or continued sideways grinding. The deeper the wall of worry phase lasts, the higher the ultimate blow-off potential, making short-term weakness an opportunity rather than a threat. Let's get into the interview.
Well, if the gold-silver ratio gets to, I think it's probably going to go somewhere between 20 to 31, that's a sign that the bull market is coming to an end. The metals are severely overvalued. You need to find something else that's undervalued. If the Dow gold ratio goes to, I'm going to guess and say 3 or 4 to 1, then it's time to sell your gold and silver and buy stocks. Stocks are undervalued. Gold is overvalued. So those are the two main things I'll look for. You'll also see the move will have become very parabolic. Silver will have probably done certainly 100% within a year, probably 200 or 300% within a year. It'll be stretched insanely far above the 200-day and especially the 200-week moving average. These are all the kind of things that get maybe inexperienced retail traders very overconfident, and so that's why you see the public buying. They don't really know what they're doing. They're just copying their name. But these are dangerous signs when price gets stretched that far above the mean, and when the price of silver has gone up 200% in a year or 300% in a year. It's dangerous at that point. And it means you got to sell. But the main one is just the gold silver ratio. If it gets down to between 20 and 30 to 1, and then also the Dow gold ratio. Let's look at that 1980 high in gold. Should an investor have held on to his gold and silver at that top? Took 45 years for silver to break out. Do you really want to hold for 45 years? Well, I mean, inflation's going to keep going, and it'll just move to a different area. Inflation was pumping up stocks during the period that gold and silver were in their long-term secular bear market. So how well did somebody do by having this mindset that they had to hold on to their gold and silver from that 1980 top? They should have sold that gold and silver and bought stocks. Stocks were undervalued. They would have made a lot of money. It's not going to be any different this time. Gold will get overvalued. Stocks will get undervalued, or something will. The dollar will probably be undervalued. And it's just the way markets work. They move from periods of extreme undervaluation to periods of extreme overvaluation, because human emotions never change. We go to extremes on both sides. So, well, first off, I don't have enough years left to survive a 20 or 30-year bear market in metals to just get back to even, which in inflation-adjusted terms would be losing, an extreme amount of wealth, even if the nominal price got back to even. So no, I absolutely will not hold on to my gold and silver when the time comes and the markets say, hey, this is insanely overvalued. All my neighbors are buying gold and silver. I need to sell my gold and silver to my neighbors. Stocks, if the Dow gold ratio were to get down to 3, then I would, and we were to have like a big, nasty bear market in stocks. I don't generally buy individual stocks. They just have company-specific risk. I would just buy the indexes, the QQQ or the SPY.
As this cycle matures, the signals that truly matter are the ratio extremes, those rare moments when gold and silver become so stretched relative to the broader market that the trend can no longer sustain itself. When the gold-silver ratio compresses into the low 20s and the Dow-gold ratio sinks toward 3 or 4, that's where this bull run enters exhaustion. Those conditions reflect not just enthusiasm, but full-blown parabolic pressure, the kind that pushes prices far above long-term averages and invites emotional buying from the public. At that stage, metals aren't strategic, they're crowded. That's when capital quietly rotates toward whatever has been left behind, whether equities, the dollar, or broad market indexes. The message is simple. Ride the trend, but recognize the moment when the market stops rewarding patience and starts rewarding discipline. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.